Hello, and welcome back to another session of Reflections on Investing with the Cornell Capital Group. And today, we're going to tackle two related issues. First, has the recent drop in stock prices brought the market back to a normal, quote-unquote, level? And second, and it's related to that word normal, can you use the price-earnings ratio to determine whether prices are once again in a normal range? And before we go there, though, I want to review one thing that we did at the Cornell Capital Group early on in our reflection series. And that is when you ask, are prices too high? Too high relative to what? The price, you can have it be anything you want by just changing the shares outstanding with a stock split or a reverse stock split. So the price isn't what's important. It's the price relative to some metric, like earnings. The trouble with earnings is the price depends not just on the current earnings, but on all future earnings. So what we'd really like is a price to value ratio. But what makes that difficult and more speculative is trying to figure out how you estimate value. Well, with all that said, today we're going to look at the price-earnings ratio with a little warning related to this notion of value. So let's go over to the computer and start with the ratio of the average price of all U.S. stocks to next year's forecast of earnings, what's often called 12-month forward earnings. We're now at the computer, and I have on the screen the ratio of the price, average price for all U.S. stocks to 12-month forward earnings. And you can see it goes up and down quite a bit. And most recently, it was very high, matching the level of the dot-com boom, essentially. So to give us some perspective, let's put the average price-earnings ratio in there over the entire sample period back to 1985. And there it is. And you can see that where we are now is almost right back to the average. And some analysts have used this to say that the current bear market has washed the frothiness out of the market. Prices are no longer too high relative to earnings. We're back to normal times. But there's a but here. That ratio depends on price, which is unambiguous. You can observe those in the market, and earnings. So let's take a further look at earnings. Here's a graph of the earnings for all U.S. stocks. And as you can see, there's a very sharp spike in the last couple years. Earnings have shot up. If earnings shoot up, that brings down the price-earnings ratio. So you might be concerned that earnings are now abnormally high, thereby depressing the price-earnings ratio. Well, how are we going to determine if earnings are abnormally high? One way to do that is to look at profit margins. For every dollar of corporate revenues, what do they take in profits? And here's a graph of that. And you can see that profit margins are at an all-time high by quite a bit. In fact, if we put the average profit margin in there, we're currently at a level that is almost double. Now, profit margins are sort of a measure of how the economic pie is divided between corporations, workers, and other people. So you wouldn't expect profit margins to remain at that elevated level. If profit margins decline back toward the average, as they always have, that means earnings are going to fall. And if earnings fall and prices remain the same, the price-earnings ratio is going to rise substantially. So, the conclusion that the market is back to a fair valuation based on PE ratios using the current extraordinarily high earnings may very well be misleading. Therefore, investors should be careful in relying on the current PE ratio to conclude that the risk of further market declines is over. This has been Reflections on Investing with the Cornell Capital Group.